Okay, let's talk about Freehold Royalties. If you're an income investor, you've definitely seen this name pop up. It's got that big, juicy dividend yield that just screams, "Look at me." But the real question is that high yield a sign of a fantastic investment, or is it a classic value trap waiting to spring? Let's dig in.
And that really is the question, isn't it? When you see a 6% yield, it's tempting. You start doing the math in your head, but is Freehold Royalties, or FRU, actually a smart buy at its current price?
Look, we're not going to make you wait until the end for the answer. The analysis is pretty clear on this one. No. Right now, the stock appears to be overvalued. Plain and simple, you'd be paying more for it than the numbers suggest it's actually worth.
So, how did we land on that no? Well, that's what we're about to break down. We're going to start with what Freehold actually does. Then we'll get into the nitty-gritty of the numbers, check out a SWOT and scenario analysis, and then, and this is the important part, figure out what the right price to buy might be.
All right, first things first. Before we can value a company, we have to understand how it makes money. Freehold's business model is really simple, but simple doesn't always mean stable.
So, Freehold is what's called a royalty company. The easiest way to think about it is like this. They're a landlord for the oil and gas industry. They own the mineral rights to the land, but they don't do any of the dirty, expensive work like drilling. They just let other companies do that, and in return, they collect a royalty check. It's a great setup, super high profit margins, really low costs. But, and this is a big but, their entire income stream is tied directly to the wild swings of oil and gas prices.
Okay, now we get to the core of it. Is this stock really overvalued? The only way to know is to compare its intrinsic value, what the business is actually worth, to its market price, which is what people are paying for it today. And this table tells you everything you need to know. Using a couple of standard valuation models, the analysis pegs Freehold's true worth somewhere between $14.80 and $16.20. Now, look at the current price. $17.64. The market is clearly paying a premium.
Let's put that even more simply. The analysis suggests the company is worth, on average, about $15 a share, but to actually buy a share today, you've got to cough up over $17.50. That's a gap you just can't ignore.
So what this creates is what smart investors call a negative margin of safety. You're not getting a discount, you're not building in a cushion in case things go wrong, you're actually starting in the hole, paying more than it's worth, and that's a risky place to be.
So why is this happening? Why is the price so much higher than the value? Well, let's dive into the financials, because a couple of numbers jump right off the page as major red flags.
And here is red flag number 1, and it is a big one. The dividend payout ratio is nearly 193%. Let that sink in. For every $1 the company earns, it's paying out almost $2 in dividends. It's like trying to pay your mortgage with a credit card. Sure, you can do it for a little while, but that is just not sustainable in the long run.
And this is why that payout ratio is so concerning. The company's earnings fell off a cliff, dropping by 72.5% year over year. This just hammers home how completely dependent they are on those commodity prices. When energy prices fall, their earnings tank, making that big dividend promise almost impossible to keep.
Okay, let's zoom out from the hard numbers and look at the bigger strategic picture. A SWOT analysis is perfect for this, and then we'll run through a few different what-if scenarios. So after weighing all the strengths, weaknesses, opportunities, and threats, Freehold gets a final score of 5.8 out of 10. You know, that's not terrible, but it's not great either. It basically paints a picture of a perfectly average company. It's solid, but it's not a world beater.
Now, what about the future? Well, in a bear case where oil prices stay low, the stock might only be worth $11. The base case is that $15 value we already talked about. And even in a super optimistic, everything goes right bull case, the stock is only worth about $19. When you're already paying over $17.60, there just isn't much reward there, even if you get lucky.
Okay, so we've established that today's price is too high. But that doesn't mean it's a bad company, just a bad price. So what is the right price? This is where we get a real actionable plan together.
I love this table. It's basically a cheat sheet. It tells you exactly what price you need to pay to get the annual return you're looking for over the long term. Want a 7% return? You got to buy at or below $14.80. But if you want a really solid 9% return, which is the target in this analysis, your entry point needs to be way down at $12.80. And how long you plan to be in the investment makes a difference too. If you're only holding for 5 years, you could pay a little more, up to $15.50 to get that 9% return. But for a true long-term 16-year hold, you've got to be disciplined. That buy price has to be $12.80 to give you that cushion you need.
All right, it's time to bring it all together. We've looked at the business, the value, the price, the risks. Now let's weigh the risk versus the opportunity and come to a final, clear verdict.
And really, these scores tell the whole story. The risk score comes in at a 6.2 out of 10. That's moderate risk, mostly because of that commodity exposure and the dividend situation. But the opportunity score is actually lower at 5.9, which confirms there's just not a lot of upside from here. And when the risk is higher than the opportunity, that's a clear signal to be cautious. So if you remember nothing else, remember this. Freehold has a simple, profitable business model, but it is completely at the mercy of oil and gas prices. Right now, the stock is trading for more than it's worth, that dividend payout is a huge risk, and a much more attractive price to get in would be somewhere below 13 Canadian dollars. And that leads us to the final verdict from the analysis, and it's a simple one. Hold. This isn't a recommendation to sell if you already own it, but it is definitely not a buy at today's price. The smart play here is patience. Wait for a better entry point. And there you have it. That's the deep dive on Freehold Royalties and why that tempting high yield might not be worth the risk right now. It's a great lesson in looking past the shiny object to see the real value underneath. So, what's another company you've been curious about? Let me know in the comments which stock we should break down next.